Hello and welcome to DoubleLine's 2026 Credit Market Outlook. I'm Phil Gioia, Client Portfolio Manager here at DoubleLine, and I'm excited to be moderating today's conversation with three of DoubleLine's portfolio managers. First, we have Robert Cohen. Robert is the head of our Global Developed Credit team, covering investment grade and high yield corporate bonds, as well as bank loans. Next, we have Ken Shinoda. Ken is the head of our Securitized Products team, and also the head of our Residential Credit team. And last but not least, we have Morris Chen. Morris is the head of our Commercial Real Estate team. So gentlemen, thanks for joining today. So we're actually running this back, right? We did one of these at the end of 2023, and we got a lot of positive feedback from investors. They found it very helpful to hear what we're thinking about, looking at the year ahead, talking about where we're seeing opportunities, and perhaps most importantly, where maybe some risks are emerging. So we'll cover all of that again today, looking at 2026, but we also have a special topic that we'll discuss, and that's around AI, right? It's on a lot of investors' minds, and we've seen a lot of headlines this year, and we think that will be a theme going forward. But before we get into all that, perhaps we can take a step back and maybe set the stage. And Robert, we'll start with you. So in our 2023 year-end outlook, you talked about how the biggest risk heading into 2024 was not owning enough credit. Now I know this because every time I pass Robert in the hallway, he's like, hey, remember that time I said not owning enough credit was the biggest risk? And then just walks away. I'm kidding, Robert, you're much more humble than that. But in all seriousness, you ended up being spot on, right? I think high yield was up, close to 10% in 2024? But that was almost 2 years ago. A lot has changed. We have a new administration, we have a Fed that's cutting rates, and we have valuations that appear stretched across many parts of markets. So heading into 2026, how are you thinking about the corporate credit market?
Yeah, a little different this year. As I said, I thought back then that the risk was not buying enough credit. Quite simply now, I think the risk is owning too much. Spreads, I don't remember when we had the actual discussion. It was late 2023. And high yield spreads were mid 300. I think it's certainly possible that high yield spreads could move back out to that level. We're in an environment where, as you mentioned, credit spreads are very tight, but also performance is very uneven. So not every sector and not every company is doing well. Some sectors are actually in some level of significant stress, maybe not distress, but stress. Chemical industry, for example. Manufacturing broadly is not doing very well. We follow the ISM numbers and they're pretty weak. And so while the headline, you see the S&P is up and AI, which we'll talk about, is the hot thing, and you're seeing stocks in that sector perform very well, that's not true across the broad economy. So I think the risk for next year is if you own too much credit broadly, you could end up owning the wrong thing, and that could lead to mediocre returns. In that environment, certainly there's a clear possibility for spreads to widen as volatility picks up, as performance starts to wane. And so really I guess the key for 2026, I think, is very active credit selection. It's not a buy an asset class or buy any any kind of broad theme. It's about careful credit selection and using risk management to avoid exposure to potential spread volatility that I think we'll see next year.
So selectivity, you think, will be key next year?
Absolutely.
Active management?
Yeah. So owning too much credit instead of not owning enough
might be the biggest risk.
Is maybe the headline.
Beautiful. Ken, maybe moving on to you. You have a monthly series that you do called Channel 11. For viewers that haven't watched that, you can check that out on DoubleLine's YouTube channel. Go check it out after this video, though. But in that video, right, in that series, you cover everything from macro to equities to fixed income to commodities. So a very kind of all-encompassing picture of what's driving markets month over month. Two-part question to start. Maybe what's one theme that you've noticed that has stayed persistent throughout the year? And then maybe what's one theme that has changed or the narratives have shifted from when you started talking about the beginning of the year to now?
Yeah, I mean, in similar vein to Robert's comments about owning credit, it was just about owning fixed income after the big rate move that we saw. And a lot of people, I think, were afraid because rates were rising so rapidly. But the all-in yields on many sectors were in the high single digits, low double digits. So from those entry points, even if rates kept rising, you would see, we thought, really good returns. And that's definitely been the case. kind of the easy money was made in 2024, and 2025 going into the year was a little bit more difficult because of valuations. You still had a good kind of beta momentum. I think in 2025, one of the big themes we talked about was that corporate credit had already enjoyed a really good rally, so spreads were pretty tight there. And what would happen is there would be capital rotation from money managers, insurance companies, which have raised a lot of money in fixed rate annuities, and that was going to come into the securitized markets, which had lagged corporate credit. And so buying securitized assets would lead to some good returns, especially agency mortgages, which were like the redheaded stepchild of the bond market. That turned out to work out pretty well. Agency mortgages are up over 8% on the index. It's outperforming corporate bonds and high yield on a total return basis, not because there's anything wrong with corporate bonds and high yield, but they enjoyed their spread tightening in the past. But now, valuations have come in on many parts of the credit markets, and I think Robert hit it spot on. Like, you could have just bought a low-cost passive ETF that bought high yield, and you could have made money, right? It was kind of a beta trade. But a lot of I think the easy money has been made, and now you're gonna see more volatility across the performance of various asset classes based on, what's going on in different parts of the economy. So I know it's self-serving because we're active managers, but we really believe that, picking and choosing the right pockets of the market, both within the corporate credit market and the securitized market, is going to be paramount to solid performance going forward.
Yeah, talking about picking and choosing the right parts of the market, Morris, as it relates to commercial real estate, I think that's a very important sector where you have to do the due diligence, right, and have to do active management. And I feel like you and I, for most of last year, wrote a white paper almost every month, right? We're getting a lot of questions from investors on commercial real estate. Those questions have abated somewhat, right? We're not getting as many questions this year. I think we're seeing a little bit more optimism, right? We're seeing transaction activity increase. On the CMBS side, we're seeing a lot of issuance, right? The most issuance we've seen in almost 20 years. So heading into 2026, how are you feeling about your space, the commercial real estate sector?
Yeah, I think with the focus now not in CMBS, just given the AI and activity that's going on in the corporate space, I think for CMBS, for the first time in 3 years, we're starting to see some normalcy. And what I mean by that is the issuance number, right? 160 billion for this year is what we'll probably end up with. I think from a 2026 sort of standpoint in itself, we'll probably see another 160 to 170 billion, depending on which research you read, in terms of estimates, and I wholeheartedly believe that. Yesterday, I was with the head of West Coast at JLL, and his comments was that this year, in terms of fee revenue income, this is just more inside baseball talk, but they're having a banner year in terms of fee revenue. This is a brokerage, which then implies that it corroborates with the data that we're seeing in terms of transaction activity, right? Just an increase in volume in terms of properties being traded. And mortgage brokerage also increasing, and then ties into the issuance that we're observing. So I am very optimistic with respect to the amount of deal flow that we're going to be able to see, as Robert kind of mentioned in terms of selectivity. When you see so many different deals that's coming out, at least on the CMBS side, you're going to have a lot of options. And this to me is the first time in 3 years where we get a lot of options. And there are pockets of CMBS where borrowers don't have, it's the only place that they can access financing. They can't go to a bank, the deal's too big. I'm using single asset, single borrower, for example, SASB market. Some of these deals are 500 to $1 billion to even $3 billion in size. You need the CMBS market. So you're not going to get adversely selected. The borrower needs to come to market because they've delayed their refinancing. And so I think, all in all, I'm excited to see the primary market perk its head. And at these spreads, since a lot of people aren't really paying attention to CMBS, given the AI craze, I do think that there's going to be some good buying opportunity in CMBS.
Yeah, and I know your thesis for a while was we'd have this positive feedback loop, right,
Yes.
where it was very tough to see, what a property was actually valued at because there was so little transaction activity. But as transaction activity increases, you'll have more clarity into, where properties are trading. That will allow for more transaction activity and so on and so forth. So I think we're starting to see that this year. But to your point, CMBS or CRE has taken a little bit of a backseat to something called AI. And I saw an interesting chart the other day comparing NVIDIA's market cap to the 20 largest companies in Europe, and NVIDIA's market cap is larger than those 20 companies in Europe combined. So certainly a large driver of what we've seen in the equity market this year has been around the AI trade, but it's not just on the equity side, right? It's also we're seeing some activity on the debt side. So Robert, maybe turning to you, can you talk about what you're seeing as it relates to AI on the credit side?
Yeah, I think we have to put it in context first. So you mentioned the equity markets. There has been a significant amount of activity in the equity markets, and the artificial intelligence have driven a lot of returns in the equity markets. So if the S&P is up, I don't know, 15% or so, some estimates suggest that half of that return is from AI companies. It's not just the Mag 7, NVIDIA, Alphabet, Microsoft, so on. It's actually, there's a whole collection of suppliers who sell to those Magnificent Seven companies that have had incredible stock returns, in some cases actually better than the Mag 7. Some suppliers are up 100% this year. So it's definitely an equity story. It is an emerging credit story. So I think we have to put it in context. The exposure is not significant in the credit markets yet. In corporate credit, there's probably across investment grade and high yield, maybe 10 direct artificial intelligence infrastructure deals. Just so we're speaking the same language, we're talking about infrastructure, building data centers to support artificial intelligence. It's just starting, but the estimates are that the industry is going to spend in excess of $5 trillion. So that's really going to hit basically every capital market. It's going to hit the public equity market, the private equity market, private credit, which is a big topic. Certainly going to hit investment grade credit, high yield, and then parts of the structured product market, CMBS and ABS. And so to raise that much money, they're going to have to go everywhere. I think the important thing to contextualize is how much of it is backed by very strong balance sheets. So, for example, Google, Meta, and then companies like Microsoft and so on are building this infrastructure to support AI. Many of the fixed income bonds that are issued in the corporate credit market are backed in some ways by those companies. So they have either direct or implicit support. And the credit markets are efficient and understand that, and the yields reflect that, so they have investment grade yields. There are other deals that are basically speculative because they're not backed by one of these large so-called hyperscalers. I think that's where the real credit risk sits, because that's sort of building on spec. So that would be equivalent of like the housing market, building a house without a buyer. And we're seeing some of that emerging, but it's not here yet. But the key thing really, if you just broaden out, if you open up an old corporate finance book, it tells you that companies are supposed to engage in capital projects where the net present value of their cash flows are in excess of their cost of capital. But if you listen to all of the hyperscalers, they basically say, we must spend. They are not doing a net present value calculation on the cash flows of those assets. They just are in an arms race, and they're going to spend money, and they're going to figure out whether it's profitable later. Now, that's totally fine if you're Microsoft or Alphabet or many of these other companies that have nearly bulletproof balance sheets. They still generate substantial free cash flow. Their net leverage is basically zero, and they have global scale, so they can absorb some of these investments being unprofitable. But if you're the standalone data center, or you're lending money to the standalone, and that thing goes bust, you're going to have to look to some parent support. If it isn't there, that's where the credit losses will be. And the way the markets always work is the first deals look pretty good, and then the next ones look a little bit worse, and then a little bit, and then worse.
Trickle-down effect.
It trickles down where it gets a little bit lower in quality, and then 2 years later, you've got some real garbage. So right now, it's a select number of transactions. They're not all great, but most of them are structured in a way that I'd say is sensible. But the way the market works, the next ones are where the risks build. So by some estimate, the investment grade credit market could have 20% of the index exposed to AI infrastructure. And usually when a sector goes from de minimis to large, that's a red flag that there's problems. So we shouldn't say that we're on the verge of some cliff here, but I think we need to be on high alert that these transactions are coming, credit quality is going to be very mixed, and then ultimately the ultimate economic activity is that people are spending money not knowing if there's going to be a return, and we're going to have to wait until later to find out if there's going to be a return. They could be fabulously profitable. They might not be profitable at all. Chances are it's going to be a mix where there's going to be winners and losers, and there's going to be some pain felt in the future.
Yeah, it sounds like they have almost like a field of dreams mentality. If you build the data center, tenants will come.
Absolutely.
And perhaps some tenants will come, but to your point, maybe
Some. In some places they won't.
Yeah.
So.
And you mentioned too, we're seeing some crossover within the securitized side, right, on the ABS and CMBS side, as it relates to data centers. So Morris, maybe you could share your thoughts on how you're thinking about that AI trade within CMBS.
Yeah, just given the amount of financing that's needed, it's undoubtedly, it's absolute truth that we're going to be seeing more deals come through, whether it's in the CMBS or ABS market. The deals that we've currently observed in the CMBS market, you can classify them as non-AI oriented data center transactions. I mean, they are, co-location, web-based storage type of data centers. The older school or previous generation data center, those, and you're going to start to see this argument of, is this hyperscale, is this co-location? And I think that's that tiering of, hey, we're not this, we're this. And I'm laying this out largely because that's going to be, investors are going to be answering a lot of questions about what are my risks, and investors also need to understand there's different types of data centers that are being used. So in CMBS, what we're seeing largely is the co-location type data centers, the older generation. The mitigants to that is, there still continues to be, online cloud storage needs associated with that, and so, such as those transactions should be, pretty safe. I'm of the opinion that it just depends on the price, right? You need to look at excess spread relative to traditional, investment products. So I can use CMBS for context. There's a, really well-performing mall that we can all collectively agree on. Today we're in LA, so we'll use Century City Mall for context. It's a very productive mall. If those bonds are trading at, the AAA bonds are trading at 120 over, and a data center bond is also trading at 120 over, one, I would ask, why are you looking at the data center bond when that thing is proven? You can walk it, you know what the alternative use case for it, you know what the land use case for it is. And so it's a price question, and I think there will continue to be price discovery, and year to date we've observed that CMBS market participants have asked for price concessions for data center deals. We started the year off in parity with data center versus a traditional property type, and then we're ending the year with data center bonds actually widening out in CMBS. So I think the CRE market, at least from a commercial real estate investor standpoint itself, you're seeing that play through, and I think you're going to continue to see that in ABS as well, where investors are going to start poking questions. People are going to get smarter, but I think all in all, there's definitely going to be excesses in terms of this, and which means that the idiosyncratic outcomes on the negative side can be real. So investors just need to make sure that you're being compensated appropriately for that, right? After all, we are in the debt, right? We're getting interest and principal. That's the most that we can get. So it's not like buying Microsoft stock.
You're saying that the CRE investors are the smarter investors right now, or the smartest investors, and eventually others will catch on to that. Say that tongue in cheek, but
we for now are very skeptical, and there's the recency bias.
Mm-hmm.
We just came from a market where we're questioning literally everything. What is the value of this office building right now?
Mm-hmm.
Right, like that's probably, that we probably know the answer now, but there's a lot of skepticism on the CRE side. That also kind of ties into CMBS, like the guardrails for lending. It's still very tight, meaning lending criteria is tight. Lenders have been burned, investors have been burned. So, the production in terms of the vintage of new loans that are coming out, to me, the lending standards are probably tighter than any other asset class that you're observing, maybe absent of residential. right?
I was going to say, yeah, skepticism within commercial real estate, where you're not seeing a lot of skepticism, or where you haven't been seeing skepticism, has it been residential housing, right? It seems like home prices only continue to go up. We have seen a little bit of a pullback, but Ken, it's a question that we get a lot from institutional investors, our thoughts on the U.S. housing market. So maybe, you lead our non-agency RMBS team, have a front row seat into what's going on in the housing market. Maybe share some thoughts there.
Yeah, well, when COVID hit and when rates started rising too, I put out a couple white papers. Everyone thought, the world was going to end and housing was going to collapse. And really the thesis for why things would remain stable and maybe home prices could even go up was the same. And it was all around supply and demand. And demand was obviously picked up during COVID as people were looking to escape cities. Mortgage rates were low. Home prices were lower then too. But supply was low going into COVID. It's still low. Existing inventory of homes got all the way down to about 800,000 units, existing inventory. In the US, 800,000 units, where we have cities with tens of millions of people. And today, inventory has gone up a little bit. We're probably kind of in just a little over 1 million existing units, and new homes have increased in building. So I think we have about 1.5 million units of new homes a year being built. So let's call it that's like roughly like 2.5, maybe 3 million on the high end. Going into the GFC, existing inventory was I think 3.5 million plus 1.5 million new homes, which is 5 million, and then we had 5+ million foreclosures. So you ended up with 10 million basically units out there, and rates fell and home prices didn't go up because people naively think home prices work like bond prices, right? If rates go down, home prices go up. It doesn't work like that. Home prices fell, rates fell, and home prices didn't bottom until 2012 when inventory levels got back to the kind of equilibrium level, which was around that kind of 2.5 million units. So we still have really low inventory, but home prices have gone up a lot. Mortgage rates are pretty high. So affordability is definitely challenged. What I think you're going to start seeing is that it's going to be a regional story. The places that went up the most and saw maybe the most building because the prices were going up, so the developers went to those areas. These are places that are seeing demographic growth, a lot of times because of low taxes. Florida, Texas, Colorado, Arizona, we're going to see weakness there. You're already starting to see it. I think Florida is probably one of the worst performers. Higher insurance is also hurting some of these areas as well. And then the places that lagged, like the Midwest, are doing the best now. So the Midwest up in some places double digits, and you're seeing high single-digit declines in the Southeast. So it's a regional story. I think the Midwest and Northeast will do the best. You could see price declines in kind of like the South and the Southeast. And it's, home prices probably go sideways, maybe up a little bit. And your bad scenario is that economy slows, maybe more supply comes on the market, and maybe you see some home price declines. But from a bond investor standpoint, we own so many bonds backed by loans made in the past that they've experienced a lot of home price appreciation, people making their mortgage payments, amortizing their mortgage down, that we feel pretty good about the credit. I saw my credit calamity during the GFC, so now we joke that both agency and non-agency mortgages is one of the places you can kind of hide out from AI. And you can get the same spreads, if not more, than some of these data center transactions. We can buy AAA non-agency mortgage bonds that are pretty short duration, kind of 145, 150 over. So that's kind of the conversations that we have as a team is, here's this asset, maybe there's more risk than people think. If we can replicate that same spread in other sectors, let's move capital and pivot away. And there's times when there's not a lot of discussions of that because there's not as many risks, but with valuations where they are, these kind of conversations are very topical these days for us.
Yeah, so maybe that's a good segue into where you're seeing opportunities. And you talked a little bit about on the residential credit side, but maybe just looking at residential mortgages broadly, right? So both agency and then the non-agency mortgages. Where do you think the biggest opportunity will be for investors in 2026?
I think diversified credit portfolios is kind of the way to play it. I don't think there's necessarily one sector that is screaming cheap right now. And I think it's a lot of it's going to be driven by supply. There's going to be I think there's going to be more supply than people have historically expected. And when you get a lot of supply from all markets, you're going to see a ton of supply coming from AI deals and IG. They're going to see a bunch of deals come through the high yield and bank loan market. CMBS issuance is going to be up. I think RMBS issuance is going to be up. So we're going to have a lot of choices. And sometimes when there's too much supply that hits, pushes spreads out, that's when us as a team need to talk to each other and try to kind of move capital around. So I don't think there's one sector that necessarily screams, this is the sector to buy. There's definitely moments of that, in 2023, 2024, when high yield got to, the wides and spreads in October of 23, that was a buy. When everything was tightening and CMBS was lagging in 2024, CMBS was a buy. But right now, I really think it's, you got to take that diversified approach. So we like kind of a multi-sector credit theme.
Yeah, you talked about us buying, CMBS, and it still represents a relatively large overweight across a lot of our portfolios. Morris, within CMBS, are you seeing, opportunities? We talked about AI and kind of your views there, but where are you seeing the opportunities across either property types, geography, bond structure? What are your thoughts there?
I think CMBS from a sub-type perspective, subsector, there's three areas, right? It's conduit, commercial real estate CLOs, and SASB. I think the SASB market, just given the amount of unique deals that would come out, I think even year to date, there's been close to 100 unique SASB deals. And so next year, and similarly, I think, if the issuance comes out to based on what is projected, you're going to have 100 plus unique SASB deals. So I think the SASB market will be very interesting because of the increased transaction activity that we're observing. And for us, it's every single asset, single borrower deal that comes out. They're very unique in nature, and we can invest across property type. We can invest across locales in terms of geographic locales. So to me, the SASB market, at least for CMBS, presents a lot of opportunity. The conduit market continues to be pretty status quo. I think the 5-year fixed rate program has been wildly successful for commercial real estate borrowers. But I think next year it's more, you're going to look at more of these trophy deals, especially as people also start buying properties more and more. There was an article yesterday that was very indicative of the sentiment, and this is on the Wall Street Journal, and it talked about, is it time to buy commercial real estate? And if it hits the screens like that, when you're even on the Wall Street Journal, then to me, it tells you that people are warming up to that idea. Mm-hmm. It just comes down to, how do we diversify away from the outsized returns that everyone already has generated from AI? How do we protect that? Where do we go? And I think securitized products overall, is a place to be, right? That you can hide out in mortgages, even in commercial real estate as well, to get away from that.
Yep. So diversifying across property types. Ken, you talked about owning a diversified credit portfolio. Robert, where are you seeing opportunities within corporate credit? Right, you're looking at investment grade bonds, high yield bonds, bank loans. Any specific area you're looking at, or is it kind of the same sentiment, looking at a diversified portfolio?
Yeah, I guess I'll stick with the diversified theme. I think it's important to identify that corporate credit is a representation of the whole economy. So if there's an area you don't like because you think there's emerging risks, whether it's technology risk or cyclical risk, there are places to go. So if you want to be defensive, you can invest in healthcare. That's by its very nature defensive. Insurance, so insurance is a significant issuer or sector in the corporate credit market. Aerospace and defense. Defense isn't really cyclical, it's tied to government spending. So there are areas where you can get pretty safe yields, and that's really what we're trying to do, is find safe yields. So one thing is picking the right sectors, but I think the theme that worked in 2025 that I would speculate will work even better in 2026 is trading volatility. So the beginning of the year, we had very tight spreads. In our corporate portfolio, we were shedding risk because we were in an environment where spreads were tight and the credit curve was very flat. So we went into the tariff volatility with a very low risk portfolio. And what we did in April, after the tariffs were announced and all the volatility hit, we said it's time to go through our portfolio. What do we own and what do we not own, and what should we look at? And that was a spectacular buying opportunity. Now with spreads tight, we're back to the environment of wanting to trim risk. I think that playbook will work next year as well. So while we're sitting here today in December of 2025, I think it's time to start trimming risk again. But I think there'll be another volatility event next year, which could create another buying opportunity. But as Ken said, I think the broader opportunity is to take the pieces across all of our sectors and collect them into a portfolio that gives you the safest yield. So I think there are parts of the corporate market that are safe. I mentioned, for example, healthcare, insurance, defense, and we talked about RMBS and CMBS. There are ways to play that. And you put that together, we might find pieces of all these sectors that you put together into a very attractive portfolio. And the timing of the trade may not be synchronized. So maybe today we lean more on the structured product market, but if this volatility hits, there might be a very nice opportunity in corporate credit, like there was in April and May of this year. And so it's just being able to be flexible and take advantage of volatility when it hits.
So as you think about those, opportunities and creating that diversified portfolio and trying to maybe not time markets, but just, time in the markets and rotating to where you're seeing opportunities, a lot of that, to your point, is going to be driven on what risks emerge.
Yeah.
So what are you thinking about in terms of risks as we head into 2026?
Yeah, well, just to comment on the timing, it's not that we know the timing, it's just when valuations are very rich, it's easy to sell. So we have a high yield bond that is trading at a spread that looks like an investment grade bond. It's not hard to sell that and wait for something to happen. Mm-hmm. So we don't know the timing. In January of this year, we didn't know the timing or severity of the tariff volatility, but we know when spreads get very tight, there's kind of nowhere to go. The risks, I actually think 2026, from a credit perspective, I think the economy will do fine. I don't see any really elevated risk of a recession, which is when you really lose money in credit. I think next year will be the risk building year. I think the excesses that will cause problems down the road will likely be coming. Those risks will be born through new issuance in 2026. So that's really what I see, is that tight spreads and a hot market, a strong stock market will lead to, as we've been discussing, issuance pretty much everywhere. And those are the risks to be worried about, is all of a sudden you have this growth of new issue, and in sectors that are new, in structures that are somewhat novel, and that's where the credit risks happen, and that's where we have to be careful. And so again, just to go back to the same theme, if we find ourselves in an environment where we see very speculative deals with very tight spreads, we're supposed to be moving money to some other part of the portfolio, and that's what I think we'll be paying attention to next year.
So maybe risks brewing, but unlike what we saw this year in April when everyone was winning, we saw risk assets kind of fall off a cliff.
Yeah, I mean, certainly I think there's a possibility for volatility, but that doesn't mean we actually go into a full-on sort of crisis or economic downturn. I'm sure there'll be a scare next year. There always seems to be something, and those creates volatility that creates the opportunity. But my expectation more is that 2026 is the year that the risks are built instead of the loss experience that everyone's worried about.
Ken, what about you? What do you see as the biggest risk next year?
I think from a macro standpoint, if you see some kind of deterioration in the labor market, which is starting to seem less and less likely, because the next Fed chair is likely going to be pretty dovish, so there'll be support from lower rates. We've got more fiscal stimulus coming with the big beautiful bill, and as you peel back the onion and some of this data that we're finally getting, if you looked at the services PMI today, some of the respondents were talking about tariff uncertainty is kind of now in the rearview mirror, and maybe there's going to be a pickup in hiring that happens. So I think the market was worried about weaker jobs numbers because we had a couple of those weak non-farm payrolls, but maybe the economy reaccelerates in the next year with some of these problems behind us. The other thing that's out there is concerns around long-term rates. Not so much in the U.S. right now, but in Japan, you're basically at the new highs on the 30-year JGB, and that has kind of pushed global long-term rates higher. So, we're still spending, and there's more spending coming potentially, not just in the U.S. and other countries, and you could see another bout of kind of concerns about fiscal, which could push long-term rates higher. So I think a move higher in long-term rates, I'm not saying that's the base case, that would cause a shakeup in markets too. And that would probably be a good buying opportunity for credit because, who cares what the long bond's doing, right? And if you can buy, pick an asset class and spreads are wider by 50 or 100 basis points just because market vol is up, like that's the best time to buy. So we as credit investors, we want those type of events, especially when it's not related to our sectors.
Right.
Because then we can buy assets at wider spreads, usually because of technical spread widening and not because there's like an increased fundamental risk.
Yeah, and to really all of your points, if you have that diversified portfolio and certain pockets of that portfolio don't get impacted as much, you can use that as basically a funding opportunity.
Yeah, 2023 was tough because everything widened because it was a sell everything market. But if you go back in time, there's other periods of vol. 2015, 16 is a good example. It now seems like a long time ago, where it was kind of like an energy-related
High yield
thing. So CLOs widened, CMBS widened, and mortgages held in. And so you could have sold the mortgages and bought high yield or CMBS or CLOs.
Well, that's why the tariff sell-off was a great opportunity. So we were buying high-yield bonds. One in particular was a security company. Had nothing to do with tariffs. It's a U.S. company. It had no international exposure. Yet the bonds are selling off with all the tariff-related companies that are importers or have components coming from overseas. So there you got the advantage of the wider spreads because of the volatility without being exposed to the thing that caused the volatility. So those are the best buying opportunities where you're sort of getting something on sale without having the defect or the problem to deal with. So I think those are the things to always be on the lookout for.
Morris, how about you for risk for 2026?
Yeah, I think some of the noise that's percolating within the private credit market. To me, it's largely idiosyncratic at this juncture. But if you have one of those large enough of an idiosyncratic event, news cycle latches on, and then you can have some corporate spread widening moment, which then add the supply dynamics in terms of technicals of new issue market. Across all sectors, you could probably potentially see some spread widening. So, and we saw a little bit of that, 2-3 weeks ago. I do think that news didn't go away, or that issue hasn't gone away yet. So to me, it's that type of noise. I don't see. I agree with Robert. I don't see any sort of prospects for a large-scale economic slowdown, but it's going to be somewhat technical. Driven in nature.
To end, we'll do a lightning round, and just to jump ball, whoever wants to answer first. But if you could describe credit markets in one word for 2026.
Boring.
Boring. Hey, we're bond investors, right? We like boring sometimes.
That's right.
Hot.
Hot. Okay. Morris.
Choppy.
Choppy. All right. So we have boring, choppy, almost the opposite of boring, and then hot. So we'll see what happens. I'm sure we'll do one of these either next year or the following year, and I'm sure one of the three of you will be right for how we categorize the markets next year.
As long as they're not all wrong. I mean, we want at least one of us to be
With those
I
answers,
hope I'm
one of
wrong.
them is
I hope
right.
I'm wrong. I hope it's choppy.
An exciting year. Yeah. All right. Well, gentlemen, thank you. I thought this was a really great conversation. I'm sure our investors found this useful. And for investors watching this, viewers watching this that want to learn more about DoubleLine's thoughts, you can find all of our thought leadership on our website at doubleline.com. Again, we have a YouTube channel that you're watching this on right now. We have a lot of interviews that Robert's done with various media. We have Ken's Channel 11. Morris has been on various media outlets. So follow and subscribe to DoubleLine's YouTube channel. Thank you all for watching. We hope you and your families have a happy and healthy holiday season. And we'll talk again in 2026.